Good afternoon, everyone. Welcome to this TradeStation webinar series. It's a series because we're going to do a collection of webinars that are based on futures trading. And today is the first of those webinars that focuses on futures trading as an alternative to stock trading. I'm not really sure how many futures traders we have here in the room, but I want to welcome everyone to this webinar. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. And we are always glad to see people joining our sessions so that we can teach them about trading, teach them about our trading technology, and everything related to the markets. As you can see, I'm joined by my colleague, Brandon Wendell. He's an expert trader and educator, and we're going to pass the microphone over to him in just a moment. I just have a few announcements and some disclosures to go through, so just hang on tight with me and we'll get the session started in no time. In the presentation, please keep in mind that every symbol and idea that we talk about is for educational purposes only. TradeStation doesn't make any recommendations when it comes to investments in the markets, and also that active trading is not suitable for everyone. Past historical performance is no guarantee of future results. And also that Brandon Wendell, even though it's great to have him here and presenting for us, he's not affiliated with TradeStation, and his ideas and services are his own. If you need additional information on these disclosures, go to www.tradestation.com/important-information. One thing that I wanted to mention also is that at TradeStation, we're working really hard to provide what's called a Futures Education Center. We just started creating content, and this webinar is one of those first pieces of content that we are releasing in the futures category. If you are aware of the Options Education Center, it's also a portal. Let me just bring it up here on the screen. The Options Education Center, we worked on this center the whole year of 2024, and we have many articles and webinars focused on equities options. But now it's our turn to create content on the futures asset class. And we're going to create a series of webinars and also some on-demand educational series. So stay tuned. We don't have the Futures Education Center built out yet. As I said before, we're starting to create the content, but very soon we'll have it available. And this webinar will be part of that Futures Education Center. However, we will have an archive link. So if you're looking for a recording of this class, we'll have it ready and it'll be sent to all of you that have registered for this webinar. And if at any point you have questions about our content or where to find certain pieces, please feel free to reach out to us. Let me just put in the email address right here in the chat so that you all have it. It's education@tradestation.com. All right, well, thank you everyone again for being here. I'm going to pass the microphone over to Brandon. Brandon, thank you so much for being here with us. And I'm just going to mute and turn on my camera. It's all yours.
All right. Well, thank you very much again for having me. Appreciate it as usual. I'll go ahead and share my desktop in a moment here as I get things set up. Should be good to go. Let's send a request. Let's see. There we go. Screen one, and we are good. Okay. So welcome everyone. My name is Brandon Wendell, as Jesus mentioned, as it shows on your screen. And basically, I have been involved in the markets for, like 25 plus years. I started teaching trading and investing since 1999, and I'm actively trading both futures, options, and Forex a little bit as well. I was a former trader for a brokerage. I actually started off as a retail broker and moved into back office operations, where I was basically seeing what made markets move. It was kind of cool. I ended up moving to a private hedge fund and started trading for the fund for a while. Got a little burnt down on that and became a chartered market technician, which is a master's degree in technical analysis. So I learned all the different types of indicators and tools, charting methods, things like that. And I share that with my students. I ended up getting in the education realm because I found it helped me as a trader to help others. I'm kind of reiterating and I'm just sharing my knowledge with other people. It makes me a better trader as well, which I love. So we're going to jump right into this because this is not about me. This is about you and your education regarding the futures markets. So hang on for one moment. So from this webinar, a couple of things we should expect. Let me get this going here. Number one, what are futures? Actually, before I get started, I always like to know who the heck is in my workshop and to get an idea of kind of your experience here. And someone asked, how many of you have traded futures before? Is there anybody who actually has experience in trading futures? You can give me a 1 for yes, 2 for no if you've never traded futures before. Okay. And as far as the question, level 1 or level 2 or 3, you're talking about options levels. That's something completely different. We're just talking about futures. Okay. So, not dealing with the options and options levels. We're talking about futures as an asset class that you can trade. So, we're going to talk about what they are, how they're traded, and I've been back been a while. Great. Okay. Well, they're not something you really need to fear. You just need to understand what they are. And you'll understand as you go through this, when you get to technical analysis and charting, there's not a whole lot of differences in the charting than there is from looking at stocks. Obviously, fundamentals are going to be a bit different. There are some other things that you'll see, but more of an options person, that's actually even better. If you can add futures, one of the things that Jesus mentioned is we're going to be adding in a lot of education. We're actually going to be adding in education on options on futures. When I say we, it's actually TradeStation. They contract me to come in every now and then and talk about them as well. But they're going to be adding in a lot of information both on futures, futures options, how to tie it all together and expand your universe. So there's a lot of cool things you can do with these contracts. And basically that's what they are. They're contracts. We'll talk about the different categories, what's available, and there's going to be more workshops coming up in the future with more details. This is just the basics, getting your feet wet, getting to understand the basics of what futures are. So we'll talk about contract specifications, how to know what to actually trade, and some of the basics. Who trades it? Why do they trade it? Why would you be interested in trading it? So it's going to be fun, but you also got to know the dangers. Yeah, everybody wants to focus on the good stuff, and oh boy, this is opportunity. Well, yeah, when there are rewards, there's also going to be risks. So you should never, ever get into any endeavor in the markets or probably in life, to be honest with you, but definitely in the markets. Do not get into any securities without fully understanding what the risks are involved in that security. What could go wrong and how is it going to affect you and your money? You got to understand that. But the nice thing is we can get started pretty simply, and TradeStation has a lot of great tools to help you do that as well. So, what are futures? Basically, they're a contract, and a contract is an agreement, legally binding agreement. Basically, a contract has to have five main things. You have to have a buyer, a seller, something being transferred or done. Say for instance, like a sports contract. There has to be compensation, and there has to be an expiration date. That's a contract. It doesn't matter if it's a contract to purchase a home or if it's Jalen Hurts in my Super Bowl winning Eagles, but they have a contract. Sorry, I had to throw that one in there. But these are futures contracts. You maybe heard me say that before. And it's simply a legal contract. Now, you don't actually sign the contract. You sign documents for your account, but you're entering into a contract to either buy or sell an asset on a specific date or buy a specific date during a specific month. It's got to have an expiration contract when it's going to be delivered. And this transaction is facilitated through an exchange. The largest exchange and the most popular exchange in the world is probably the Chicago Mercantile Exchange. There is more volume and more things traded through that exchange as far as futures contracts than anywhere else. There are some other exchanges. TradeStation has relationships with a few, but really most of the contracts are right there in the CME that you'd be interested in using. There's a few in what they call the ICE exchange as well. So we'll talk a little bit more about that coming up. And basically, they're in agreement to buy or sell something at a specific price at a specific date. Could be gold, could be the index, it could be euros, it could be yen, it could be a lot of different things. Live cattle, crude oil, we'll see. But that's all it is. It's an agreement to buy or sell something, a specific amount of something at a specific date for a specific price. It's a contract. That's all. So if you've traded options, it's almost the same, isn't it? An options contract is the right to either buy or sell something. In this case, usually it's an underlying stock at a specific date for a specific price, the strike price. So when it comes to the CME products, there's quite a few different products out there that you can trade. And basically, you've got agricultural products, corn, wheat, soybeans, livestock, lean hogs, live cattle. If you ever watched a movie from the 80s, Trading Places, no, there are not pork bellies anymore, but they do have a cut pork, I think is one of the futures. Not as heavily traded. But there are a lot of things you can trade out there. Soy meal, some of the derivatives of soybeans. Even if you're not a farmer, there still may be some benefit for you to do what's called speculation or trading to potentially profit from the price movements. In addition, we have energy products. A lot of you live up in cold areas like myself. You have to worry about heating oil and purchasing heating oil. You can actually use contracts to try to offset some of your costs that you have to pay for your winter heating. You have gasoline if you drive a car. Obviously, you've got some issues with gasoline, unless, well, it depends on what you drive, I guess. Anyway, we got nat gas, crude oil, lots of different things to trade. Obviously, gold, silver, copper, platinum. I mentioned those already. Metals. There are interest rates. You can trade the interest rates. As a matter of fact, just a few moments ago, we had a Fed announcement. The Fed funds rate is a futures contract that you can trade. So are the longer term bonds that affect your mortgages. So I used to be a mortgage broker, and I actually would track the 10-year and the LIBOR and chart those to know when to lock in personal loans that I was selling to people, or even for myself for real estate. So you could trade those as well. You can trade equities rather than trying to go out and pick the best stock that's going to make the most amount of money or short the best, stock. You could trade the entire market. You can trade the entire 500 stocks of the S&P 500 in one security. Yes, I know you can do the SPY, but there are some benefits to doing S&P 500 futures, the ES, and we'll talk about those. Or the NASDAQ 100 instead of QQQ, you could trade the NQ. Instead of trading the diamonds, you could trade the YM, that's the Dow futures, and so on. So they're reducing QT to 5 billion per. Okay. Anyway, Forex. You can actually trade currencies through futures. It's pretty wide open. There's quite a few things. And I mentioned there's one category that's not there because it's not necessarily a CME product, and that is softs, what we call softs. Coffee, cocoa, cotton, sugar, and lumber. Those are also tradable. They're typically traded through the ICE futures index exchange. But as you can see, the majority of the things that we trade typically as futures traders, well, I should say, I can't make the generalized statement, but the most heavily volume traded securities are right there on your screen. They're available through the CME. So how do they work? Well, imagine you're a farmer and you obviously want to sell your wheat that you're growing at a fair price. If the prices drop, it hurts your farming, right? And a baker is a user. I'll actually get to that question in a few moments, Lawrence. Actually, no, you do not need 10,000 to trade futures Forex. No, you don't. Okay, depends on the brokerage, but I believe you only need, there's a minimum with most brokerages. You have to be able to afford the contracts, and I believe it might be around $2,000, but check with TradeStation to make sure, because I don't work for them, I don't know. But no, you don't need to have a certain minimum, I believe. So anyway, getting back to the contracts here. If you're a farmer, you obviously want wheat to go up or at least hold at value so you can sell at a reasonable price. Bakers don't want the prices going up because they want to buy at a reasonable price. Well, the farmer and the baker, they could actually agree to produce the wheat, deliver it in the future when the baker needs it at a certain price. Now, in reality, this doesn't happen. Okay. So they don't actually go back and forth and trade with each other, but they just go out and buy the contracts through the exchange. So if a farmer is worried about the prices going down, they could sell a futures contract and lock in the price that they're going to sell their wheat. And if the value of wheat goes down, they can either deliver the wheat through the contract, or they can buy back their contract, and the profit between where they sold and where they buy it back offsets their loss in the real world wheat. The baker that needs to buy the wheat, they don't want to buy all their wheat that they need for a while because they have to store it somewhere. So they buy it when they need it, right? Well, what if the prices go up? If they buy a futures contract, they could either force someone to deliver the wheat at the contract price before it goes up, or they could sell their contract for a profit, which is more likely, and the money they make offsets the higher cost. So that's usually what happens with futures. So it's called hedging. You're using futures to offset a real life need in a market, in a commodity. So in this case, again, if they were to go with each other, just for some reason, the exchange happened to match them up, the farmer and the baker, they agree to sell 100 bushels of wheat for $5 a bushel in 3 months. Well, if it's $5 per bushel, 100 bushels, the farmer's going to receive $500. And the baker knows that they can buy the wheat at a specific price no matter what happens. Prices go up or down, it doesn't matter. So yeah, that's kind of neat. You can lock in your price ahead of time. What happened here? There we go. So let's talk about some of the features of futures. And yes, I'll open up for some questions at the end here. I'm going to be way ahead of schedule, so we should have plenty of time for questions. Thank you. So, first of all, most commercial, when I say commercial traders, those are people who are either producing, big farmer conglomerates, Cargill or Monsanto, things like that. The big companies, they want to manage price fluctuation so it doesn't hurt their company. Or some company like Starbucks that buys a lot of coffee beans. They may want to manage risk by locking in prices of coffee beans at a certain level, and they use futures to do that. So those are what we call commercials. They're actually using the specific commodity in their everyday life, and they're using these futures to help offset risk. So obviously, things change. Gold, wheat, oil prices fluctuate, they go up and down. And they can use those currencies, or sorry, not currency, they can use those contracts to lay off risk. Again, that's called hedging. So the futures contracts, they lock in prices, they reduce uncertainty, and protect themselves. That's the main reason why futures contracts were actually created. Now, it's expanded obviously since then. Things have changed quite a bit. So, first of all, when you trade something, you need to know what it is you're trading. Most people, when they go to look at a stock they want to buy, they learn what the company does, they learn a little bit about their history, the people involved in it, is it a good company they feel comfortable with, or whatever it may be. We need to know what's being traded and how is it being traded, because with futures, it's not like stocks. Stocks are pretty simple. One share of stock represents a piece of ownership in a company. One futures contract could represent different sizes of things. It could be a certain amount of soybeans, it could be a certain amount of crude oil. It's not the same measurement for all those. So we need to know what's being traded. We have what are called contract specifications. So, first of all, with the contract specification, what is the underlying asset? Are we using trading commodities? Are we trading financial instruments? Are we trading an index? What is that size? There's a standardized quantity for each futures contract. So you can't change that size. It's set by the exchange. If you want to trade one futures contract of corn, it is 5,000 bushels of corn, no matter what. You could buy multiple contracts, but each one contract is 5,000 bushels. Every crude oil contract is 1,000 barrels. So yeah, if you have crude oil, it's 1,000 barrels or 42,000 gallons. Now, there are different sizes because we have what are called minis and micros that are available as well. So you can go ahead and trade those to adjust your size. But each individual contract has a specified size based on what the exchange assigns it. And the price quotation. Sometimes they're expressed in pennies, sometimes in points, sometimes in quarter points, sometimes they're in hundreds or thousands of a penny, or whatever it may be. The price quotation is in the contract spec. The tick size is the smallest movement for that particular security. And tick sizes vary depending on what it is you're trading. Okay, again, if you're trading currency, it's different than if you're trading oil or if you're trading corn or if you're trading the NASDAQ. They all have their own individual tick sizes and tick values, and they have different months of expiration. Most of the time, when you're dealing with the indexes or when you're dealing with the interest rates, you have quarterly expirations. They have contracts that expire every 3 months: March, June, September, December. When you're dealing with certain physical commodities like crude oil, they have expirations every month. If it's something that's being grown or harvested or slaughtered, that's the livestock. Sorry, that's what happens. But what happens with those, they go by the calendar of growing season, harvest season, and slaughter seasons. So they'll have different contracts that seem almost random, but they actually make sense for that industry. So you need to know the months that are available for those contracts. You also, very importantly, need to know when's the last day that can be traded. When does the contract expire? And we'll explain why in just a little bit, but you can only trade a contract while it's still valid. Once it expires, it's no longer valid. You can't trade it. So you need to know also what kind of delivery. Is it physical or cash settled? Cash settlement's easy. Loser pays the winner, right? If you buy a contract and the value goes up, you're going to receive profits for that difference. If you buy a contract that goes down, you're going to owe. Physical delivery is a little bit trickier. With physical delivery, you could get stuck with a bunch of cattle being dropped off at your house. Now, actually, it won't happen. With TradeStation, especially, there's notifications that they send you. As a matter of fact, if I think I have TradeStation open right now, if I go to my message center, there it is. No, that's not it. There it is. There's TradeStation's message center. Once you open up TradeStation, it opens up. And obviously right here, we got the webinar going on, but going a little further back, attention futures clients trading February NYMEX crude oil. And look at this. It says, be sure to roll or offset positions by close of business Thursday, January 18th. This is the older message, obviously, because these contracts are physically deliverable. You do not want 1,000 barrels of oil being dropped off in your driveway. And actually won't happen. If you go into the futures agreement because you want to trade futures at TradeStation, you'll see there's in the agreement, you are not allowed to take physical delivery as a TradeStation retail customer. What will happen is if you ignore those messages, and you'll get plenty of messages, trust me, you'll get those pop-ups, you'll get the message center, you'll get emails if necessary, I believe. But basically, if you ignore all those, they will close the position for you before you have assignment or having to deliver or receive those physical deliveries. And they'll charge you for it. Okay, they will close your position for you, the trading desk. Anyway, when it comes to contract size, the futures contracts or units, the sizes vary depending on what it is you're trading. One contract is one contract unit. So as I mentioned before, if you're trading crude oil, it's 42,000 gallons of crude oil or 1,000 barrels. So this is all set by the exchange. Okay, everything is found on the exchange website, and you should get used to finding that information. It's very simple, to be honest with you. If you go out to, let me see here, there it is, my browser, who is allowed to get those deliveries? The commercials. They have to trade through certain brokerages and have exchange rights to be able to do that. But like I said, retail customers, we just don't take delivery. So right here on the CME group, I go to CME.com and I go to markets, and we were talking crude oil. Let me go there. I go to crude oil. It brings up right here, specs. Those are the contract specifications. And I can see 1,000 barrels traded in US dollars and cents per barrel. Tells me when it's traded, the minimum price fluctuation or tick, as I zoom in here a little bit for you, right there, there's the tick. Symbols, how it's traded, it is deliverable, so I have to be worried about when is it going to be settled? When is it going to be the last trading day? Well, they tell you. And of course, like I said, TradeStation does a great job of letting you know as well. If you have a settlement procedure and you want to learn how do you get delivery, there you can click on it, find it out. Okay, and there's more information as well. We'll get into some of that. So the tick. This is very important. If you're going to trade something, you need to know the tick movement and value. How does it actually trade? In stocks, it's very easy. It's every penny, right? Stocks move in penny increments. But when it comes to futures, they all vary. In the S&P 500 E-minis, you have a 1/4 point tick, and that's worth $12.50. However, the NASDAQ also has a 1/4 point tick, but that one is only worth $5. Okay. Nat gas, that trades in a thousandth, right, of a point, or 0.001. Okay, that's tens, hundreds, thousands. So that's $10. Crude oil trades in pennies. Basically, that's a tenth of a penny. This is a penny. So a point is a whole number price increment, and it can be made up of many ticks. For the S&P, 1 point would be 4 ticks because 0.25 is a tick. Crude oil, 1 point is going to be 100 ticks because it's every penny. So you'll see that there is a lot of times it'll be listed tick size, tick value, and point value. So natural gas is actually not 25,000. That one's incorrect. I'm sorry. That's only 10,000 for the point value. I have it incorrect there. Anyway, when it comes to the prices and the way you're trading these things, we typically look at what's called market value or spot value. That's what you see on the chart. So for the NASDAQ 100, at the time I looked at it when I was making the slide, the price was 20,800. That was the point value or spot value, market value. That's not the actual value of the contract, though. If you want to know how much of the NASDAQ you're actually trading, you simply multiply the market value by the point value, and it'll also tell you how much you make or lose. Okay, so right here, the NASDAQ 20,800. If that's the spot market value, and we go down by 50 points to 20,750, you don't lose $50. The point value is $20. So a 50-point move loses $1,000. That's on the NASDAQ. So if we were to go out right now, let's see, right here, I actually have the NASDAQ up. Let's go the specific though, NQM25. And this is live. This is the NASDAQ right now. We're at 19,889. Okay, and I'm on a daily chart. Let's go to 15-minute, just because I'm curious to see how much of a swing we just got, because the Fed announcement just came out, and you can see we're getting some price movement now, as expected. But anyway, when you get a 1-point move, you can see how it's moving in ticks at 0.25. But if you get a 1-point move, that is actually $20 of value, because that's the point value for the NASDAQ. So that is the price quotation, or what we call market value or spot value. And you have to multiply that by the point value to see how much you actually make or lose. And yes, this is recorded. It'll be available on the TradeStation website. Absolutely. Now, notional value is the actual value of that future. In the case that I was just using, well, let me do it this way. If I go calculator, what do we have there? We were at 19,860, we'll call it. 19,860. That's the market value times $20. That contract is worth a little under $400,000 right now. That is what we call the notional value, or the actual value of the contract. That's literally how much that contract is worth. When I was looking at this at one point, the NASDAQ was at 15,650. Well, it was actually valued at $313,000. So the value has gone up. We went from 15,650 points to 19,000 points. We went from a value of 313,000 to trading over $397,000 worth of stock. Now, why do you even need to know this about notional value? You need it if you're going to do some more advanced type trading. I do a lot of what they call spread trading with futures, where you're actually trading contracts against each other. Or if you want to hedge a portfolio, you need to know these things. For instance, you can use futures to protect yourself against a market crash in your 401k or your IRA. That's pretty cool that you can do that. But you use notional values for that. So just keep in mind, if you're regular trading, for the most part, you deal with the point value and the market spot value. But you may need to know what the notional value is if you start to get a little more advanced in your trading. Now, when it comes to settlement, as I mentioned before, you have two types of settlement. You either have physically settled, which means there's delivery of whatever the underlying security happens to be, cattle, gold, oil, or cash settlement. Loser pays the winner. So commercial traders, they might actually want delivery. It's not an easy process. There's warehousing and distribution and transport involved. So we typically don't do that. As I mentioned before, TradeStation's customer account agreement, if you go in and look for it, you'll find it. There's an account agreement you can sign up. When you sign up for futures, you have to sign it. You have to acknowledge it. All that fine print that nobody ever wants to read. Well, I've read it. It's in there. And you are not allowed to take delivery. Okay. So if you're a TradeStation customer, basically you don't ignore the notices that come up. What you have to do is close your position or do what's called roll. And we'll deal with roll in a more detail in a future webinar. But just think of it this way. If you have a position that you want to keep going, but the contract's expiring, you close that position, take whatever profit or loss there is, and reopen a new position in the next contract, the one that hasn't expired yet, that's going to be next. That's all. So again, if you want to know more about how that roll and everything works, we're going to cover that in a little bit. Not today, but another workshop ahead of time. Anyway, cash settlement, that's pretty easy. Like I said, if the end of the contract comes and you bought it at a lower price than it is now, you'll get paid the difference. If you bought it at a higher price, you'll have to pay the difference, and vice versa for selling. So some of the other things you have to worry about with contract specifications, there's a little more going on here because, again, it's contracts that we're dealing with, and there's trading hours. When I showed you the contract specifications on the CME website, trading hours were shown there, expiration dates are shown there, number of contracts available. Not that you need to know the contracts available, because you're probably not going to hit the limits. Okay. You can trade a lot of contracts, but they get expensive. One thing you do need to be aware of is something called a circuit breaker or a price limit. Are they on that security? Are they going to be affecting you? Because it can happen, and it does. A circuit breaker, it's like your house. If you pop a circuit, what happens? Whatever was on that particular circuit shuts down, right? Now, what do you do first? Don't go click the circuit back on because it's going to pop again, right? You got to unload the circuit first, okay? Unplug whatever's causing it to pop. I always ask that question in class a lot, and people say, "Oh, you just click the circuit back on." Yeah, and watch it pop back off again. No, what happens with circuit breakers is you have to unload the circuit, then you turn it on and fix the problem. Okay. So basically, what happens is with circuit breakers are if the markets move too far too fast. And when it comes to indexes, it's really just to the downside, although there's certain ways it can click on. If the market were to drop in one trading session 7% or 13% or then 20%, the market shuts down for a period of time. It's not permanent for the day. It could come back on. It pauses for maybe 15 minutes up to a couple hours, depending on when it happens during the day. And all that's available online. It's not something that happens too often, but if there's a major panic, and it has happened, these were created after 1987, the market crash. And it happens more overnight than it does during the regular trading hours typically, but it has happened. Anyway, it's usually energy markets and the indexes. If markets drop by too much or even rally too much, they can shut down the market for a period of time, allow everybody to cool off, unload the circuit, and then restart the market. Well, the price limits are more like a fuse box. If you blow a fuse, you got to replace the fuse after you unload the circuit. It takes a little more time than just clicking back on the button. So what happens is these price limits are a little different. You don't stop trading, it just halts price. They have what's called lock limit. So if there's so much of a panic that you drop down a certain amount on corn, then it can't drop any further. There can be trading at that level or it can go back up, but it cannot go beyond that level. You get what's called lock limit down. Or if it goes too high, if there's too much buying going on, because eggs are not traded, but if you were trading eggs, there was a shortage in eggs and everybody started buying eggs and driving the price up, there'd be a limit that they can't go above. And you'd be able to buy or sell contracts, but you cannot go above that price. It would get locked at that limit up. And limits can get expanded the next day, but for that day, you could be locked until the market closes. So be aware. And it's also, again, inside the contract specs. Let's see if I scroll down. There it is. Price limit or circuit. And you click on price limits and it'll bring up the lists right here of price limits. Those are the prices. Dynamic circuit breaker variant. It tells you exactly how prices can move up or down and how much when they will shut down. If I go to agricultural products, I mentioned corn. Let's see, where is it here? Corn and mini-sized corn. If we move outright, that's the one you worry about right there. Don't worry about spreads. But if we go up or down by 30 cents in one trading day, you get lock limit. You get stuck and you cannot go any further. You can trade at that level, but you just can't trade beyond it. During COVID, it wasn't really all that bad. It wasn't that stressful. I mean, when it was first announced and things were happening, there was volatility, absolutely. I don't remember we had a lot of limits, though, going on then. For the most part, there's two types of traders. I kind of mentioned this already, but we'll go in a little more detail. We have speculators and hedgers. For the most part, we are speculators. We're speculating on the future of those futures markets and how we're going to trade them to make profits. We don't actually use the underlying asset. I trade lean hogs, but I don't have any hogs. Okay. Yeah, I eat pork, that's fine. But I don't deal with the underlying asset. I am trying to profit from the price movement. That's all. And that's all speculators are doing. We try to take advantage of price movement in various assets. So speculators can include farmers and miners and banks, and obviously lots of us, the retail traders. There's also investment firms that do a lot of speculation in order to make profits for themselves and for their customers. The other type of trader, and there's actually a few others beyond this, but I'm only taking the two main ones. The other type is hedgers. And that's where I started off. That's why these were created. Starbucks, the large coffee chain, they want to hedge against rising costs for their coffee beans they need to buy. They can't buy all the coffee beans they need in 1 year right away because they would have to pay for storage somewhere. Or if you needed gasoline, right? You can't go out and buy all the refined gasoline that you need because you have to store it somewhere. You want to buy it when you need it and where you have the capacity to store it. So to avoid having to pay more in the future, you can use these contracts, as I said before, to offset your risk. That's all hedge is doing. Hedge is offsetting risk in real life usage of a commodity. So I kind of mentioned this one before. As I said before, if a coffee company is worried, they could buy coffee futures when the value is low. They can either take delivery because they've locked in that they're going to deliver at that price, or they can sell the contract for a profit if the value of coffee goes up, use the profit to buy the coffee at a higher price. They didn't lose anything. They gained money to pay for the more expensive coffee. Well, hedging price drops, that would be the producers. As I was saying, as a farmer's worried about, hey, I need to feed my kids, I need to make a living, but there's too much going on. Everybody's having a really good year. We got a bumper crop. The value of that commodity might drop dramatically. And what they could do before it drops is they could sell the futures contract, and that locks in a price that they could deliver, even if the prices drop at the grain elevator. Or they sell their contract when the value drops, they buy it back cheaper than what they sold it for. That price difference is their extra income that they would have lost by selling at the grain elevator at the lower price. So again, it's just stabilizing businesses. That's all hedging really is. We could do it for ourselves with our retirement accounts, as I mentioned, and we'll get into this in the future, I'm sure. No pun intended, future futures, right? But anyway, you could actually protect yourself against a market drop by selling S&P or NASDAQ futures or even options on the futures. That way, when the value of your portfolio drops, you're making profits that offset that loss. And that's pretty neat. Now, one of the reasons why people do a lot of futures trading is low margin requirements. You had a question before about trading currency futures. Do you need a huge amount of money to be able to do that? Not necessarily, no. Again, it depends on the brokerage, how much they require you to have. But if you go out right now to tradestation.com, under pricing, you'll see futures margin rates. And let's go to currencies. This is right there. I click on currencies, and you can see as I zoom in a little bit here, you've got intraday initial margin, you got overnight margin, both for long or short. Well, currencies right here. If I go to British pound, intraday, $1,100 to trade it. Overnight, $2,200 to hold it overnight. Okay, that's not bad. Now, what if you didn't have that kind of money? Again, if you want to get started with a smaller amount, trade the micro euro, 715 for intraday, 1430 overnight. There are smaller versions of these contracts that allow you to trade using less capital. And the requirement for the accounts, again, you can check to see how much the requirements are. I don't know personally, but you can check on that. The other nice thing is you don't have to have the $25,000 to be a day trader like you do with stocks. There is no pattern day trading rule. Okay, you just have to have the minimum account size to trade. I think I want to say I think it's around $5,000 to trade futures with TradeStation. I'm not positive. Again, you got to check that. Jesus or somebody from the trading desk would know more about that than I do. But you can trade futures and day trade them with a lot less than $25,000. Now, be careful because there's low margin requirements. You're using a leveraged asset. You got to be careful because you will have losses that can be greater than if you had not used that margin. So just because it only costs a couple $100 to trade a contract doesn't mean that's all you should have in your account. You want to have a buffer. That way, if you happen to take some losses, because what happens with losses in futures is they are basically taken out of your account same day, even if you don't close the position. Futures are a bit different than stocks. Stocks, you have that settlement time before, everything comes. Well, basically, if you get a loss, if you own a stock, you don't realize that loss potentially until you close it, right? In futures, you have a loss even if you don't close the position. It's what they call mark-to-market accounting. At settlement of that security, and the settlement is usually sometime later in the day, it depends on the security, any losses or gains are automatically deducted or added to your account. So be careful. Again, you got to know what you're trading. I think they're a little more efficient than stocks. I mean, with stocks, you got over 5,000 listed stocks to choose from. It might even be more now. I don't even know how many there are. But in all the exchanges, there's a lot of different stocks to choose from, a lot of scanning. In futures, there's like less than 40 contracts to really focus on. So you spend less time trying to figure out what to trade and more time doing whatever else you want to do. Again, it's a leverage asset. You do get increased buying power so you can control the NASDAQ. I said it's almost $400,000 to trade. I'm sorry, of what the value is of the NASDAQ, 400 grand, 397,000. The margin for that is about $25,000. So you're getting to trade something of a higher value. Heck, it's even less intraday for the margins. But That can also be a double-edged sword, and you can get increased losses. So you really have to be careful with the leverage asset and how you do it. You can also protect your portfolio instead of going out and buying options on individual stocks and creating collars and all that stuff, buying puts. You can actually do a protection on an entire portfolio by using the futures, the index futures. Much better, typically. So some of the advantages, you can trade with a smaller account size. There's also less correlation. Okay, so there could be some better opportunities with non-correlated securities, because with stocks, the market crashes and almost everything goes down. So when people say, oh, I'm diversifying my portfolio, not if you're only in stocks, because all the different sectors drop. Some of them just drop slower than others. And in futures, there is much more non-correlated opportunity compared to the stocks. Okay, not guaranteed, but they typically can be. The markets are open nearly 24 hours a day. When you put in a stop loss on a stock, that's a stop market order. Market orders do not exist in the after hours. After 4:30 Eastern, before 9:30 in the, I'm sorry, 4 p.m. Eastern, and before 9:30 in the morning Eastern, market orders don't work. You can't put in a stop loss that'll trigger after hours. I know they're expanding trading and things are changing, but with futures, you can. You can put in those stop losses after hours and have them trigger to protect you. So there's not no gap risk, but there's much less gap risk, especially when you're dealing with ETFs versus index futures. With an ETF like the SPY, QQQ, how many times have you seen that gap up or down in the morning? Well, you're stuck if you traded that and put in stop losses. If you trade the ES or NQ, the futures version of the index, you could actually have those stop losses trigger and get you out almost every day. Exactly. And I'm not a tax professional, so make sure you talk to someone. As a matter of fact, I think TradeStation just recently had a tax professional do a talk on trader taxation, so you can look up those archives for the video. But futures fall under what they call Internal Revenue Code 1256. And it's potentially better tax treatment than you would on stocks. You can actually get away with some long-term capital gains versus short-term. So the taxation might be saving you a bit of opportunity, a bit of money. So when it comes to futures trading from our side, all we really do is directional trading, to keep it simple. Now, I mentioned before, there are some more advanced things you can do called spread trading, which we'll talk about again in the future, I'm sure. But for the most part, if you think a market is going to go down in value, you sell the contract. It's not technically shorting, but we still use the term shorting. It's kind of what we're used to with stocks. But technically, you're selling a contract. If you think the price is going to go up in value, you buy it, period. That's it. And for the most part, use technical analysis the same way you would on the equities markets. Charts are charts. So, I can take a few moments here to take a look at some of these charts. Let me see, what else do I have left here? Just checking to make sure. One more thing though, before we go out to the platform, if I go back into the CME website, kind of help you out again with contract specifications, what I've been doing initially was simply going to an individual security, and that's one way of doing it. Another thing you could do, if you do a search on the CME website, and you could do that right from the homepage too. So if I go back to CME, anytime you're on the homepage, you'll see a little magnifying glass. Type in contract directory. It's contract directory and calendar tool that you're going to come up with. It's the first one that shows up right there. And you can bookmark that in your browser. And basically what they did is they created this thing called quick strike tools. So let's say we want to trade Forex. I click on Forex and we want to trade the Australian dollar. I click on that and it shows me these are options on futures. It doesn't really matter. We just click on one of those. And instead of looking at the option information, I can look right here on future. And guess what it gives me? All the contract information, the specifications. This is a deliverable contract. You're trading 100,000 Australian dollars with the standard contract. And I see the symbol. Now, keep in mind the symbols, we're going to talk about this in a future video as well. The symbols might be different depending on whether or not you use what they call traditional pit symbols or if you use what are called Globex symbols. TradeStation uses the traditional pit symbols. So instead of 6A, sorry, it's really minimized there. Instead of 6A, you would actually use AD. Now, how do I know which symbols to use in TradeStation? Very simple. Right under this homepage, under pricing on TradeStation, futures margin rates. And look what it shows right here, symbol root. That's how I know that Australian dollar, where was it here? I missed it. There it is. Australian dollar is AD. Pretty cool. So, like I said before, going into trading these, if I'm looking at the NASDAQ, as I mentioned before, this is the 15-minute chart of the NASDAQ currently, a live chart. The technical analysis won't change. You can use the same type of indicators. You're looking at price action. And really, when you're analyzing price action, what you're literally doing is analyzing people's behavior. Are they buying? Are they selling? And where is that imbalance between buying and selling pressure? So I am going to wrap this up on time for once. I know Jesus is going to be shocked. Are there questions? I know there was a couple of people had a couple of questions. I want to go ahead and take a look to see what I can do to answer those. And as I said before, there's going to be a lot more information coming up in the future on futures, again, pun intended. So keep your eye out for that. Let's see, Australia said options on ES, the day of expiration. What time is the closing time? Options on the ES? No, the settlement time you have to look. Again, if you go to the contract directory from the CME, if we go back, equities, I believe it'll tell you the settlement times for expiration. So for instance, if we go to these quarterlies, there's the quarterly expiration for the future ESH5. Okay, so that is the actual expiration. And it shows you when the expiration is 3/21, 9:30 in the morning. Okay. And if you're looking for the option that expires with that, they should have it here. I click on EW3H5. Oops, sorry, got to go to option. And there's the expiration 4 p.m. on the 21st. That'll be the settlement for it. That's how you find it. Contract directory. And what did I say it was? Contract directory and calendar tool. And you just do a search for it. And all that information is right there. So let's go back here. Sava had a question linking TradeStation account to TradingView account. Is that recommended versus normal desktop application? I don't know if it's recommended or not. I actually have linked the TradeStation with TradingView and it's been working fine for me, but I do a lot of options. So I prefer to use the TradeStation desktop for that because I want to have the Option Station Pro and the extra tools there that I may not have in TradingView. As far as trading futures and technical analysis, it should be pretty seamless to use that. But it's a personal preference. I don't know if there's a recommendation. What percentage of futures are traded by commercials versus speculative traders? Great question, Jack. You can actually look that up. I'm not saying you have to. I will show you where it is. If you go to cftc.gov, it's going to be individual based on what it is you're looking at. There's something right here, market data and the
Commitments of traders, right?
commitment to trader. You got it. Yeah. Commitment to traders right there. That will literally tell you how many people are trading what. So if we're going into, let's see, CME long format, and it looks really boring, but if you do a search, I'll do ES. Maybe not. Let's do S&P. That might work better. There we go. S&P 500 consolidated, and there it is. E-mini S&P. Now it's consumer staples, energy, E-mini S&P 500. Perfect. Non-reportables are us. So that's 300,000 for 450,000 roughly. However, open interest is 2.2 million. So you can see the size. Non-reportables are retail traders, everything else, that's the big guys. You've got commercial and non-commercial. Non-commercial are the big traders. Commercials are the people who are doing the hedging. They're the lion's share, obviously, right there. So great question on that one. Yankees beating the Phillies. Yeah, whatever. What's today? It's not even opening season yet. It's practice. Okay. What else do we have here? How and where we need to buy the data to make sure we're placing the trade in real time. That's a TradeStation question. You would probably talk to the trading desk. Depends on what it is you need to trade and what kind of data you need. But typically, if you're going to trade futures, you're going to, I can't go into it right now because I don't have an account login that I could show you, but you just need CME level 1 data, I believe it is, real time. And as a non-commercial, or I'm sorry, non-professional, it's going to be a lower cost. It's not really that bad, but whatever the data feed is, it's a cost of doing business for trading. But yeah, anything else? Have I known anyone that's had a future contract delivered? Not accidentally, no. On purpose, yes. Yeah. And let's see, simple micro index futures was your main concern? Sorry, I missed the question. Oh, for the TradeStation with the linking it to TradingView shouldn't be a problem. Honestly, I've never had a problem with it before, and I've linked my TradingView. But like I said, I prefer the desktop. So because there's so many more tools available there that that's typically what I do when it comes to my TradeStation account. All right, I think I got most of the questions.
You did, yeah.
All right, cool. And I'm still on time. That's even better. Oh, which futures contracts do I like to trade the most? I don't have any particular one that I follow the most. I do a lot of equities and I do the energies for the most part. but in a given day, I'll look at whatever's giving me the opportunity. That's the beauty of, with TradeStation, you can create a custom list. For instance, if I go to on this page right here, I've got a radar screen that I've created with the futures contracts. I just typed in the current front month contracts. So I have to change them. Or you could just do a continuous contract too. And I can actually filter them. I can add indicators and scan through them. Or obviously under apps, where is it now? I always miss it. That's the radar screen. But you can go to your scanner. There it is, a little flashlight. And you can create scans to run through and find exactly what it is you're looking for. I have a particular scan that I've created that has done very, very well for me over the past 15 years. And I share that in my classes that I teach for my students. But yeah, and I share it. But it's a strategy that I created about 17 years ago. And I created a scan on TradeStation that actually finds opportunities for them. And it works probably like 60 to 80% of the time, give or take, depending on how the markets are trending. So you just got to find what are you looking for. And when it comes to, let's see, I've done more in futures than anything else as far as percentage wise, maybe a little more in options, but as far as dollar wise, I've done better in futures personally. But I can't speak for everyone. That's just me individually. And how can you have Apple, Amazon, or Google stocks in futures? Those would be listed as part of the Qs, the NASDAQ. The NQ futures would be very similar to trading those. As a matter of fact, you can check, especially in TradeStation. Okay. If you want to know NASDAQ and how it relates to Apple, for instance, you could just bring a chart up and a correlation study at the bottom. You bring in one chart, add in a comparison, and then correlation. You see, let me remove this. But you have studies here you can actually check, and you're going to find a very high positive correlation between some of those stocks. And the reason why is those are major pieces of that index. So again, if I go, let's see here, correlation. Oh, where's there?
You won't be able to add it because you don't have a second data stream. But
right. I don't have the data stream right now, but I can kind of show you what it would normally do. Yeah, I don't have the data stream set up first. I got to put in the second data stream. Anyway, but I don't have time to do it right now, but that's what you could do. You can actually study and see the correlations, or you can also look to see on some web pages, like real quick, and I'm going to have to turn it over here pretty quick. But if I do, and this is just random, I'm using this one, but if I go QQQ holdings of the QQQs, number one is Apple. It's 9% of the index. So when you find the correlation, what else did you mention? Apple, Amazon, Google, Alphabet, basically. There's Amazon, 6.31%, and Alphabet is another 5% between the two pieces. Basically, the NASDAQ is going to be almost identical to those stocks. So if you were to short the NASDAQ, if those stocks drop in value, they'll move almost 1-to-1. Not 1-to-1, they'll be almost. Okay. And again, that's where you use notional value to hedge a portfolio. So anyway, that's all I got for today. For the margin rates, contact the trading desk for TradeStation. Yes. I believe it's actually on the website as well in that pricing page I showed you. If you scroll down, there's some data there. It should be right around 4 p.m. that kicks in after the close, but I believe it kicks in early before 9:30, but you got to check. Okay. I'm not positive.
Yeah. All right. Thank you, Brandon. And thank you, everyone, for your participation. You kept the chat active and you kept Brandon busy as well. So as I said at the beginning of the presentation, this is just the beginning of our futures education series. We haven't scheduled our second webinar on futures. However, if you go to the events page, you're going to find sessions that we've scheduled on Masterclass. We're doing a series of masterclass on futures spreads. So if that's a topic that interests you, please look it up in the events page. It's called Masterclass Lesson 1. We also are scheduling a recurring futures options replay where Brandon's going to talk through futures trades, and talk about the reasons why a trade may be, a good opportunity or not, and look at all the performance measures on those trades as well. So make sure that you check out the events, is my point, and see all the upcoming topics and see if there's anything that you'd like to register for. Brandon, again, thank you for your time. Thank you for sharing your knowledge. And for everyone here, we hope to see you in one of our future classes. Have a great day. Thanks for being here. Bye-bye.